here. Looks like Jerome Powell is going to be testifying shortly. 10-year note dropped down to 3.99. First time we've seen 3.99 for a very long time, and then it jumped back up. Right now, we got the 10-year Treasury at looks like it's at 402, so it jumped back up. It was just down there for about 10 minutes. We're just waiting on Jerome Powell. Federal Reserve just indicated they're going to drop the federal funds rate by 25 basis points. That'll really stimulate short-term financing, like 5-year fixed rate financing for net lease. That'll definitely stimulate it. But we're waiting on Jerome Powell here to testify. He should be in shortly. We've seen a lot of inflation, although unemployment claims are going up. We're back up to like 263,000, the highest in 4 years. CPI has been running hot still. So we have a stagflation situation where we have higher prices with eggs, food, insurance, car insurance, health insurance, travel, apparel. But at the same time, the economy's weak. There's less jobs. So it's kind of a dilemma. Although the nice thing when these rates come down for commercial real estate, there's a ton of people just sitting on the fence. Okay, here comes Jerome Powell. Let's listen into Jerome Powell's testimony. All right, here he goes, Mr. Jerome.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June.
All right, well, stronger, that's a good thing.
In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
4.3 on the unemployment
Payroll
rate.
Job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services.
10-year note just
Near-term
hit 403.
inflation expectations have moved up on
See what the
balance
Dow's doing
over the
on
course of
this.
this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6%
Looks like Dow's up.
in 2026.
Dow's up 290 right now. It was up higher, I think, and then it tapered off a little bit.
Policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size
4 to
of our
4
balance
1/4.
sheet. Changes to government policies continue to evolve, and their effects on the economy remain.
That means they're still going to taper, I think, is
Higher
what
tariffs
he's saying there. They're going
push
to
up prices in some categories of
continue
goods.
lowering their balance
Overall
sheet.
effects on economic activity and inflation remain.
That means they're going to continue selling bonds,
A
which
reasonable
is
base case is that the effects on
actually
inflation will be relatively
kind of goes
short-lived, one-time
counterintuitive
shift in the price level.
to the lower rates.
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation.
Stagflation.
When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year,
3.6.
3.4% at the end of 2026,
3.4.
and 3.1% at the end of 2027.
3.4.
This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts
Definitely
are
coming down.
and they're not a committee plan or decision. Policy is not on a preset course.
Love to hear your
The Fed
comments.
has been assigned 2 goals for monetary policy:
See,
maximum
somebody
employment
just
and
came
stable
in.
prices.
Hi, whoever
We
it
remain
is.
committed to supporting maximum employment.
Love to hear your
Pushing
comments.
sustainably to our 2% goal and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our
All right, we're going to hear some questions now.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise?
If you need financing for a net lease deal, this is the time to do it. You're going to debt service better if rates come down. If you're in a refi, cash out, take out of a construction loan,
committee member today.
call me on my cell phone. We'll do a quick back of the napkin. 760-803-6464.
Committed to
Give me a ring.
maintaining our independence, and beyond that, I really don't have anything to share.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year.
I wrote a great
Those are not
newsletter
very
when
large effects
Trump
at this
just
point.
first went in. You want to check
We do
that
expect
out.
them to
It
continue
talks
to
about
grow over the
inflation
course
and
of the
construction,
rest of the year and into next year.
building of homes and
it's
other
also
things. Just go to my
possible
website,
that there may be effects I would say
www.marabella
if you're looking at
finance, and
employment,
check
it's
out
going to
that
be
newsletter.
much more about the
We're going to have a new
change in
newsletter
because
coming
the
out
supply of
shortly
workers is obviously coming
on all the
way down.
different
There's very little growth
Starbucks,
within the
7-Elevens that
supply
are
of
for
workers.
sale
And
in
at the same time,
California that we've
demand
done
for workers
episodes of
also
Natalie's
come down quite
TV,
sharply.
and
We've
some
got
of the
to
deals
the
that
point
we've
where
closed
we
as
see,
of late.
what I've called a
So we'll be
curious
mailing
balance.
that out
You know,
shortly,
typically, when we say things are in balance, that sounds good.
and that should
In
be
this
on the
case,
website
balance
as
is
well.
because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy.
10-year note jumped back up 405 now. We were at 399.
Level, I would say. So
So
we
we're
were
up
able to do that
6 basis points
over the course of this year
in a
with
matter
labor
of like
markets in very solid
30
condition
minutes.
with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that.
He's saying it's almost
we
in
do know that they've
equilibrium
moved
now.
meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we
So
did
neutral
today.
now. Well, that's good.
What circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to.
All right,
You know,
call me if you
much
need
more
Netley's
of
financing. This is an amazing time. Rates are coming down.
and saying, well, those
With
risks
Jerome Powell, we're going
maybe
to
not
conclude
fully
this
balanced, but moving in the direction of so that
presentation of the Federal Reserve lowered rates, 25 basis points. Call me on my cell if you need Netley's financing.
Viewing today's cut
760-803
against the possibility
6464. We'd love to talk to you. Thank you so much.
The dynamics of a downturn are already in place. I guess I'm just, trying to square the shift in the